Hey there, awesome accounting student. Mark Franke here. This video is on chapter 6, which deals with internal controls, including cash controls and the bank reconciliation. This particular video, I'm going to talk about internal controls and why we need them and what their purpose and objective is. And then we're going to do problem 6-2b, which is on petty cash. Petty cash is just keeping track of small amounts of money that businesses need to have. So in front of you is a list of lecture notes. The first thing is the purpose of internal controls. The purpose of internal controls is, number one, is to protect assets. Assets obviously have value. We don't want them to be stolen. We don't want them to be fraud. We want to make sure that we control them so that they're used properly. We also want to ensure that we have a reliable accounting system. The external users and management, internal users rely on information, and they want to rely on information that is accurate. And so internal control systems are designed to make sure that if an error occurs, because that's why something is inaccurate, because there's an error, if an error happens, it's caught and corrected and fixed. We also want to be efficient in the way we do things. We don't want a lot of wasted effort on doing things that aren't useful or have purpose. So efficient operations is one of the components of internal controls, and all of that should be set down in some sort of a policy statement. Most companies call them standard operating procedures, or SOPs. These are things that the company puts down in writing saying, if you're doing this job, this is the way we want you to do that job. And so it has a list of tasks and responsibilities and how things should be done. All of this is based on the principles of internal control. And the principles of internal control are the 7 things here in front of you. Number 1, establish responsibilities. So we have people, we know everything that needs to be done, and we have people that are assigned to do all of those things. Now, there might be some cross checks and balances, and that's great because, again, we want to make sure that everything is covered and that if an error exists or occurs, it's fixed. We want to maintain adequate records. Record keeping is critical for auditing purposes, for tax return purposes, and just to make sure that we have documentation to support what's happened in the activities of the business. We want to make sure that assets are insured and that key employees are bonded. If anybody is handling cash, they should be bonded, which is basically insurance for things that happen with cash. We also want to make sure that if we have vehicles, that they're properly insured. If we have a building was properly insured. If we have if we are manufacturing a product, that we have product liability. If we have a store, that we have insurance for if a customer or employee gets injured in the store. So all of that is really risk management, trying to make sure that if something happens, that we can take care of it financially. We want to make sure that we separate the record keeping from the custody of the assets. So the accounting people typically don't have custody of assets. The accounting people have custody of the records, and custody of assets is by operational people. So we want to make sure that we keep those things separate. We also want to divide responsibilities to the extent possible. Small companies have a harder time with this because there's less employees to be able to separate these duties, but we want to separate the responsibilities as best we can. We want to make sure that in today's technological environment that we have proper controls over how the computer does things. If we have a point of sale system, We want to make sure that the cash registers that are hooked up to this point of sale system are reconciled to the general ledger every single day, and many companies do it at the end of every shift. And then we also want to have regular independent reviews, whether that's an external auditor that comes in to look, or in the case of larger companies, they have internal audit staff that go in and make sure that the procedures are being followed as just a separate check and balance system. So let's talk about cash, because cash obviously is it's the number one asset. It's always on the top of every balance sheet. And also it's something that people can spend. It's something that people want to get their hands on if they can. And so we want to make sure we control the cash properly. We want to make sure that we're collecting receivables timely. If there's a customer that is not paying, that somebody's talking to them regularly to make sure that they understand how much they pay, or if there's a dispute, that this dispute is taken care of. And from a payment standpoint, we want to make sure that we manage the payments or disbursements that go out. We don't want to pay fraudulent vendors. We want to make sure that and this is what a voucher system does, if we make a payment to a vendor, 3 things have to have happened. We ordered it. That's usually evidenced by a purchase order. We received it. That's usually evidenced by some sort of a bill of lading or a receiving report. And that we were billed for it. And that's an invoice from the company. And we want to match these things together. Make sure that somebody who's authorized ordered it, somebody who is trained and authorized to receive it received it, and then the accounts payable people match these to an invoice that comes from the vendor, and then we can pay it based on the terms, whether it's net 30 or 210 net 30 or whatever it is. That also means that we need to plan these expenditures. So we can forecast our cash flow for maybe 3 months out and make sure that we're going to have the necessary amount of cash to be able to pay our vendors, to be able to pay our employees, based on the money that's coming in from customers. And if we don't have enough cash, we might have to set up a credit facility with a bank, or if we have excess cash, we might want to look at places where we can invest that cash. And then this is the number one control procedure, is reconciling the bank account. And we want to make sure that we reconcile the bank account to the general ledger. I'll talk more about that in another video that's specifically about bank reconciliation. But so I won't go into a lot of detail here about the bank reconciliation, but the bottom line is what we're doing is we're getting a document from the bank and we're comparing it to our general ledger, and we want to reconcile. The bank records all our transactions a second time, and if we can reconcile that to our general ledger, we're going to find any errors that happen. So let's take a look at the flow chart that we have through the first 5 chapters. This is what we've done. We have customers and we have vendors. And in the middle, we have this general ledger, the Bible of the business, that keeps track of these transactions. So we have on the customer side, we sell and we collect. We sell goods or services, and then on certain terms, and then they pay at some point. We collect the money, and so in this case, we're keeping track of all of our customers in an accounts receivable ledger. We saw that in chapter 4 and in chapter 3. At the end of the month, we prepare a schedule of accounts receivable from this accounts receivable ledger, and we compare that to accounts receivable in the general ledger. And they should match to the penny. If they don't, we have a problem. We have to go find the problem, an error. It means that something was posted in the accounts receivable system that didn't get posted in the general ledger, or something was posted in the general ledger, didn't get posted in the accounts receivable ledger. This is a really strong control to make sure that all transactions were recorded and at the right amount. Same thing on the vendor side. We buy stuff from people, from vendors, whether it's goods or services, and then we pay them based on the terms. So As I said a minute ago, in that case, in a voucher system, we want to make sure it was authorized, that we received it, and that we were billed for it at the right amount, the right quantities and all that stuff. And then we pay it. We keep track of that in a vendor ledger or accounts payable ledger, which keeps track of each individual vendor and how much we owe them. And then at the end of the month, we prepare a schedule of accounts payable and we agree that in with the general ledger. Again, strong control. If the accounts payable ledger doesn't reconcile properly to the general ledger, we have a problem. We need to go find out where the problem is. We've made an error. We've posted something to the AP ledger, didn't get posted in general ledger, or vice versa, and we've got to find it. And then the last control, and this is so important, is the bank reconciliation. So the bank reconciliation is focused on the general ledger cash account. We have an account with Wells Fargo or B of A or whatever, Chase Bank, and they keep track of all the transactions in their system and send us a statement every month. What we do is we use that statement and we reconcile it to the general ledger, and that process is again in another video, and I'll talk more about that then. So what we want to do in this video for the rest of the time is to prepare how petty cash works. And petty cash is something that we keep in a business in order to make small disbursements. We need to buy a mop for the warehouse, or we need to buy some photocopy paper because we ran out and the shipment from Staples doesn't come for another week or so. Whatever it is, we have small amounts of money that we need to pay for small things, and so we keep this petty cash account. This problem is on page 264, and I'm going to go through these journal entries right now. The first one is to set up a petty cash account, and in effect what we're doing is we're just transferring some money from our regular cash account to an account called petty cash. This is on January the 3rd, and we'll use 2019. It says we established a petty cash fund of $150, so we will debit petty cash and credit cash. What happens here is somebody in accounts payable writes a check to a person, whoever it is that's going to be in charge of keeping the petty cash. It could be the controller's assistant, it could be the controller, it could be whoever. But some way we designate somebody that's going to be in charge of this money, and they have to keep track of it. So this is to open a petty cash account fund managed by Mary Jane in the controller's office. Now, one of the things I wanted to mention is the reason that the chief accountant in a business is called the controller is because of this whole chapter is internal controls. If we are controlling the accounting system so that there are no errors and everything is used efficiently and assets are protected, that is the job of the controller. And the controller is the chief accountant in any business. Then what happens here is Mary Jane is giving money out to people to go to Home Depot and buy a mop, or going to Staples to buy some photocopy paper, or doing whatever it is, and they bring back a receipt. And so she's keeping track of the receipts in this petty cash fund in some sort of a little ledger or just a little sheet or something. And then on the 14th, we reimburse the petty cash fund. So on January the 14th, we reimburse the petty cash fund for $87.72. And we add up all of those little receipts. We have some supplies expense for $14.29. We have some inventory that we purchased that was necessary for production or for whatever. We have repair expense if we had to pay somebody to come in and repair something, just a last minute thing, $38.57. We have some miscellaneous. That's my personal favorite. I don't really like that account, but it's only $12.82. And then what happened is we are short. Mary Jane wasn't doing a very good job apparently of keeping track of stuff, and she has a shortage. So we're going to hit an account called cash over or short and over. It's always short, it's never over. Money doesn't appear, it usually just disappears. And then we're going to write a check for $87.72. And this is to reimburse the petty cash fund. Notice that there's no entry to petty cash here. We're not increasing the petty cash fund. What's happening is Mary Jane is giving us the receipts, we're recording the expense, we're giving her a check for $87.72. She's going to go to the bank and cash it, bring it back, put it in the drawer along with the other money, and she should have $150 again. But for whatever reason, she decides that she needs more than $150. So on the 15th, we're going to increase the petty cash fund. We're going to make the exact same entry we made initially: debit petty cash $50 and credit cash. Again, we're writing a check to Mary Jane for petty cash, and that is to increase the petty cash fund. Then we get another reimbursement for $182.65. We are short again, and in this case we have a calculation that would be useful, so I'm going to do that. But let's go ahead and put the journal entry in. Here's on the 31st. We have some advertising expense, postage expense, merchandise inventory, and we've got our cash short and over. Did I mention it's always short? It's never over. And then we're going to reimburse it with $182.65. So we add up. Advertising is $50. The postage is $48.19. Merchandise inventory is $78. And in order to balance the entry, if we take how much we have to reimburse, we're short $6.46. That is to reimburse the petty cash fund. And the way I got the $182.65 is the amount of the petty cash fund was $200. Mary Jane counted the amount, and what was sitting in her drawer, the remaining amount in the fund, was $17.35. Oops, negative $17.35. And so the amount that we need to reimburse it to get it back to $200 is $182.65. That's the amount necessary to reimburse the fund. And then the last entry they tell us is, I guess Mary Jane decided $200 is too much for her, and so she wants to Oh, sorry, we're going to reimburse it again. Okay, no, we're going to increase it again. Sorry. So, same entry as before, petty cash, $50, and this will take it up to $250, and credit cash. Again, we write a check for Mary Jane, she takes to the bank, she cashes it, puts it in the drawer, and this is to increase the petty cash fund. All right, that's how petty cash works. Problem 6.2b. That's it for this video. I'll do next video is on the bank reconciliation. Thanks for listening, and I'll see you again soon.